Okay, so imagine you own shares in a company. You check your portfolio one morning, and the ticker symbol you've watched for years is simply gone. Not down. Not paused. Gone, replaced by a message you've never seen before, telling you the stock has been delisted. What actually happened to your money? And more importantly, could you have seen it coming? Let's follow one company through this exact nightmare, because it's still one of the most dramatic collapses in stock market history. In the year 2000, Enron was one of the most admired companies in America. It was named one of the most innovative companies in the country for 6 years straight by a major business publication. Its stock traded above $90 a share. Analysts loved it. Employees had large portions of their retirement savings tied directly to company stock, because everyone assumed the good times would simply keep going. Here's the part almost nobody outside the company understood at the time. Enron wasn't actually as profitable as its financial statements claimed. Executives had built an elaborate structure of off-the-books partnerships specifically designed to hide massive debt and inflate the appearance of profit, keeping the true financial condition of the company hidden from investors, employees, and regulators alike. In October 2001, that structure started collapsing. The company disclosed a massive loss and a significant reduction in shareholder equity tied to those hidden partnerships. Investors panicked. The stock, which had been trading above $90 just months earlier, began a freefall that felt almost impossible to watch happen in real time. Here's the twist that made this collapse so uniquely brutal. As the stock kept falling, Enron employees kept getting told internally that everything was fine, even while executives were quietly selling off their own shares. By the time the truth fully came out, the stock had fallen below $1, wiping out billions of dollars in shareholder value in a matter of weeks. In November 2001, the New York Stock Exchange suspended trading in Enron stock and moved to delist it entirely. In December, Enron filed for bankruptcy, at the time the largest bankruptcy filing in American history. Thousands of employees lost their jobs and a significant portion of their retirement savings in the same collapse, because so much of it had been tied directly to company stock that had just become nearly worthless. So what does delisting actually mean, mechanically, once you strip away the drama of any one specific company? A stock exchange, like the New York Stock Exchange or the Nasdaq, isn't just a place where trading happens. It's a private business with its own rules, and companies have to continuously meet certain requirements just to remain listed there. Minimum share price, minimum total market value, timely and accurate financial reporting, and a handful of other standards designed to maintain a baseline level of trust in every company trading on that exchange. Here's why that matters for you as an investor. If a company's stock price falls too low for too long, often below $1 for an extended period, the exchange can issue a formal warning, giving the company a set window of time to get the price back above that threshold or risk being delisted involuntarily. If a company fails to file required financial reports on time, or if serious questions arise about the accuracy of those reports, that alone can trigger the same warning process, regardless of what the stock price happens to be doing at that exact moment. This is exactly what happened to companies like WorldCom in 2002, another accounting scandal that unraveled in eerily similar fashion to Enron, involving billions of dollars in expenses hidden through fraudulent accounting, ending in delisting and, at the time, an even larger bankruptcy filing than Enron's had been just months earlier. But here's the part that a lot of beginners assume incorrectly. Delisting doesn't always mean a company is collapsing into fraud or bankruptcy. Sometimes it's almost the opposite, and it's worth understanding the difference clearly, because one version is a disaster and the other is often completely fine. If a company gets acquired by another company, or taken private by an investment firm, its stock typically gets delisted too, simply because it no longer exists as an independent, publicly traded entity. In this version of delisting, shareholders usually receive cash, or shares of the acquiring company, in exchange for their existing shares, at a price negotiated as part of the deal. That's not a collapse. That's often shareholders getting paid out, sometimes at a premium above where the stock had been trading before the deal was announced. The ticker disappears from your app for a completely different reason than Enron's did. So how do you actually tell the difference, in real time, between a company drifting toward the dangerous kind of delisting versus simply being acquired? This is where the story of a very different, far more recent collapse becomes useful, because it shows how fast the dangerous version can move once trust breaks. In March 2023, Silicon Valley Bank was a well-established, mid-sized bank primarily serving technology startups and venture capital firms. On a Wednesday, the bank disclosed it needed to raise capital after realizing losses on its bond portfolio. That single disclosure triggered panic among its depositors, many of whom were connected through the same tight-knit startup community and communicated with each other constantly online. Here's the twist that made this collapse move faster than almost any bank failure in modern history. Within about 48 hours, depositors had attempted to withdraw tens of billions of dollars, an old-fashioned bank run supercharged by modern technology and social media, moving at a speed that older banking regulations were never designed to handle. By Friday of that same week, regulators had shut the bank down entirely and placed it under the control of the Federal Deposit Insurance Corporation. Trading in the stock was halted, and it was delisted from the Nasdaq shortly afterward. A company that had looked financially stable on Wednesday was gone by Friday. That timeline is the part worth sitting with. Enron's collapse unfolded over roughly a year, with warning signs beginning to surface for those paying close attention months before the final crash. Silicon Valley Bank's collapse unfolded over roughly 48 hours. Both companies ended up delisted. Both stories ended in the same technical outcome. But the speed at which trust can evaporate has changed dramatically, and that has real consequences for anyone holding shares in a company that starts showing warning signs today. So what actually happens to you, specifically, if you're holding shares in a company when it gets delisted from a major exchange? Here's the uncomfortable answer. You don't automatically lose your shares. Legally, you still own whatever the company's shares are worth, or aren't worth, after delisting. But the shares often move to something called the over-the-counter market, sometimes referred to as pink sheets, a far less regulated, far less liquid trading environment where buying or selling can become significantly more difficult, prices can become far more erratic, and reliable information about the company can become much harder to find. In the case of a company like Enron or WorldCom, that technical ownership ends up being close to worthless anyway, because the underlying business itself is being liquidated in bankruptcy court, with creditors typically getting paid before shareholders see anything at all, if there's anything left over once creditors are satisfied. In the case of an acquisition, that technical ownership usually converts into a cash payout or new shares fairly quickly, without you ever needing to touch the over-the-counter market at all. This is exactly why the reason behind a delisting matters so much more than the delisting itself. The word sounds alarming no matter what caused it, but a company being acquired for a premium and a company collapsing into fraud produce the exact same headline, removed from the exchange, while representing two completely opposite outcomes for the people who own shares. So here's the real lesson sitting underneath both of these stories. A stock ticker disappearing from your screen isn't the actual event worth worrying about. It's simply the final, visible symptom of something that was usually already happening well before that moment, whether that's a company's finances quietly unraveling behind the scenes, or a deal being finalized that had been negotiated for months. By the time delisting actually happens, the real story, the one that decided whether you were about to be paid out or wiped out, had almost always already been written. So here's a question worth sitting with. If the difference between a company being acquired and a company collapsing into fraud can look nearly identical on the day the ticker disappears, how much attention are you actually paying to a company's financial health long before that final headline ever appears? Let us know what you think in the comments.